We broke out today in a really big way. Again, a lot of it coming overnight. So we really broke out starting last night over into the European session. And as soon as we opened, we continued higher today. And we broke out. There were some good breakout patterns developing on the chart. The question is, have we, did we get all the patterns? Have we solidified the breakout to the point where now we're not coming back down? Or like the last couple of attempts to get above this resistance area, especially on the S&P, it failed, right? We failed. And what similarities do we see now in this move that we saw in those last couple of moves? That suggests that resistance can hold again. And if it doesn't, and we do hold this breakout, what do we need to see to confirm that? I'm going to talk about that. And then what will that mean? What do we want to see to lead us out of here? Was it the leadership we saw today? Is that what we want to see going forward? So I'm going to talk about that as well as with our trade idea from an area that we haven't really spent a lot of time in terms of trade ideas in the past. So it gives us a little bit of diversification with our trades. So let's go ahead and get started. Today is Monday, May the 18th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. A nice breakout, at least, again, it's one day and it's got to hold this. And this is barely above this line, barely above these highs. I don't think it's above, let's see, the high 29.54. So it didn't get above the high, but it is the highest closing high that we've had since this recovery. So good sign to get above this, and not so good that so much of it occurred overnight, but we'll take what we get. Strong intermediate posture still, so dark green shading on the market forecast on the back of this line, still the case. You can see we bounced off this rising moving average, so it's still green. The near term line did get up in the reversal zone. The one thing that still is a little concerning, and it doesn't have to, the momentum line doesn't have to get up in the overbought line, but we haven't had the momentum line get up here since that high point, and that was the last high point. You can see we came into April expiration with a nice good rally, and then that's it. We've been April, this May expiration cycle was flat as a pancake. Now we're starting off the June cycle here pretty nicely, and it's kind of rare for us lately, at least, to start an expiration cycle on the upside. You can see the last three have been a 2-day down there, a 1-day down there, and obviously this down period here. And even over here, we were down for a week going out of that, and we were kind of sideways after being up into the expiration cycle. We were sideways to down on this one coming out of it. So for a week. So it is a little surprising to get such a rally coming out of a expiration. It's not normal. But, on the other hand, a lot of these expirations, we were bullish, all of these, except for this one, we had a 2-day decline there. But the rest of these, we were pretty bullish going into them, and this one, of course. So that's a little different in this regard. We weren't so bullish, like I said, pretty sideways. Our options inventory class, we actually had a really, really good month in that trading room this past expiration cycle, because of how sideways we are. And we're off to a pretty decent start in June too, with a good setup so far. But this breakout suggests we might take off unless it turns into a fake out, right? And we fill in this gap, which, as you all know me, that is definitely a possibility and something you expect to happen, unless it's one of two things. Unless it's a runaway gap, and like this one here, and as of right now, this one's a runaway gap. Could this be a runaway gap as well? See here, we didn't gap through these highs, but we finished above those highs, and we finished slightly above the 38% level on that one, and that was a pretty strong opening gap. In fact, if you take a look at our opening gaps here, there we go. You can see this, back here, it was a pretty decently sized opening gap, well above 2 standard deviations. We had gapped up over 3.5%. We didn't quite gap up over 3.5%, but we did gap up almost 2%. In fact, the futures were well over 2%, so it was a little surprising that we didn't. And in fact, if you go to SPY, then you'll see we did actually gap up above 2.5%. We were over 2.33%, and that's the biggest gap to the upside that we've had in a while. This was 2.25%. That one was just over 2%. So it was really this last kind of this gap was the last one that we got as high as we did, and these were over, like I said, 3.5% gap on that one. So, is this another similar type of runaway gap that you see here? That remains to be seen, right? We'll see if you can see on the next day we gapped up higher again. Now we fell throughout the day and we filled in the gap by the end of the day, but we gapped up above 3.5% again to kind of confirm the runaway gap, number one, and confirm the fact that we got above the 38% line. We really held above it there, and so that's kind of what we would like to see. Now, we don't have to see a big black candle like this where we open up really high and then fill in the rest of the day. But, if we were to kind of come up towards 300, remember that point of control, that's where the point of control is. There's some significant resistance right there at 300. So if we can get to 300 and kind of confirm this breakout and hold it, then we are set. We are set to go there. Let's take a look at the Russell 2000 on its market forecast chart. And you'll see here that it has not broken above its previous highs like the S&P. So, it had a really good day. It was an outperforming day, but it's been so underperforming that even on this outperforming day, it hasn't been able to. And also keep in mind, too, that outperforming days on the Russell have not been, they usually, like this was the outperforming move on the Russell, and then we had that weakness. This was an outperforming day on the Russell, and that sparked this weakness. So the last couple of times that we've had good outperforming periods in the Russell, it's led to short-term weakness. Nothing significant, but short-term that where these resistance held and we rolled over. So we'll see if today's outperformance leads to more in a continued trend or more weakness. And the issue is normally we'd love to see Russell and value lead the way higher. But the problem is in this particular case, this has not been a normal bounce off of lows, right? This has been, where the Qs and the technology stocks have really led all the way through. Like the Qs have pulled away from the Russell even during the pullback and subsequent bounce. So the gap in performance, as I've shown you before, has actually gotten bigger from this peak up till now, has gotten bigger. So, it's interesting. Like normally we want to see the Russell lead, but we don't really want to see the Russell lead right now because that's not what the leadership has been. And when we have seen it lead, it's led to short-term, in the case of the Russell, it's led to lower highs and lower lows. So now it remains to be seen if we can get through into the upper half of the Bollinger bandwidth, the Bollinger resistance area here because we're coming up, or if we'll hold it again like we did the last couple times. So very important next couple of days here for the markets to confirm this breakout today. Okay, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over the subscribe button right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one tomorrow. So if that's the case, let us know. With one click, you can do that right now. If that's not the case, you don't have to click on anything. We just like to see what people are thinking and whether you like these videos or not. And it's one thing to see views in the videos, but it's another thing to see people actually like to, that want us to keep doing these. And, we don't give out surveys. That's really the only survey we got. Also, while you're down there, comment. What did you get out of the video today? We'd love to see what you're hearing, what questions or comments you have about the things that we talk about. Join our website at marketscholars.com. There's a link right there popping out in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos at DavidSettle42. Join our Market Outlook Facebook group that we've created. All right, if you're watching our videos on YouTube, on our blog here, check out some of this other things. So, for example, this Market Outlook live session. An example of that, in this session we review all of our existing trades. We went through some of our older Market Outlook trade ideas. We continue to manage them. We actually closed one of them out today. So if you're one of our subscribers, monthly subscribers or premium, you all get access to those videos. You can see the information on both of those over here on the top under pricing. You can also click on pricing to see a comparison of the two. But an example of that is we actually put our trade idea on Friday before the market closed. So by the time the market opened this morning, stocks really took off. They were up 2.5%, 3% across the board. And so, the trade idea would have been a lot different going in this morning than it would have going in Friday. Now today was a little bit of an anomaly, of course, but you get the idea of why we put on the trade ideas before the market closes for situations like what we see here today. You can see all the rest of our trading rooms that we have. My options trading room is tomorrow, as well as Brandon's really popular DGI class that he does. And also click on engage with us here on social media. Click this heart. It opens up a window. You can hit that like button. Click that thumbs up. Again, that tells us again that you like our videos. We benefit from that because the more these posts have likes, the more Facebook and Twitter will promote our content to all of our followers because of the engaging, because it's got engagement there. You also benefit because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to do that here with us. All right, back to the charts. We got a really good pattern showing up on the S&P. You'll see it's actually a lot better on our trade idea, but the S&P is really darn close to getting the Hakinyashi close, mind you, of getting above these highs. It is a higher high. It is, that we've got a higher high. We've got a much higher close. There's no lower shadows. Only one day into the week, so keep that in mind. But still, very, very good pattern. If you look at the candle trend, you can see we're flirting with the 200-day moving average. So if we can get a good break, up to 3,000, we're probably gonna have to really break 3,000 pretty hard for us to get up there and not just do where we kind of roll over to the downside. You can see the other examples when you're bearish, that we just don't kind of flirt with it and then come back down. We want to get above it like this, really good significant move above, and you got a better chance of holding even with a pullback on that case. So I even think up to 3,000 wouldn't quite be enough yet to really hold that breakout. But you got to have something first, and so it's a good sign so far, and we're only one day into it, that we're actually flirting with breaking above not only the 62% level, but also the 200-day moving average. Let's take a look at the 3 green arrow chart, and you'll notice here that we got close to 3 green arrows again. The stochastics is turning back up from what would be a phantom green arrow, this green arrow, really bullish stochastics green arrow. It's one thing for the stochastics to get so oversold that it's down in the reversal zone. It's another thing for it to turn up without even sniffing the reversal zone. And those are really, really bullish low points. And as of right now, that would be the case here. You can also see, too, that MACD, whoops, wrong one here, it's this one. You can see the MACD is close to crossing back up above its moving average. So, we kind of talked about we don't see these kind of moves on bearish trends. We just roll right back down. But we are seeing this kind of move, so it suggests that this might be another sign that we're on this bullish trend now. We've been sideways for a month, and we might be breaking out of this sideways action to the upside. They're both still below the moving averages, so that's why we're not sold yet on this breakout. It needs to really hold tomorrow and Wednesday, and not fill in this overnight gap. If it does, great. If it doesn't, then we just, like we said, there wasn't a whole lot of gaps to fill in up here, and we didn't have to fill in anything, and now there's a big one below us. That's not the best. It would have been much preferable to have a 8, 9, 10 point range, including the gap, all throughout the day instead of pretty much all overnight. I mean, look, we rose 8.72 points today, and the daily range was only 4 points. So most of that gain occurred overnight, is what that's saying, and that's not the best. Right? We prefer that not to be the case, but we'll see. We'll see. Like I said, tomorrow and Wednesday, if we can hold this gap, if we can get these blue lines above the orange lines, great. If we don't, then we see their trends. The orange lines are trending down, so we'll see if they continue to trend down. Remember, the other thing we really need to see is from these other oscillators is a break above 60 and a break of, getting back above 100. At least we got back into the upper half. We had dropped below negative 100, which is not a good sign, because we didn't come close on these two lows to breaking below negative 100, but we did on this one. So it's not the best sign, but at least we've come back up above 100, just like that. So kind of like these lows where it was a short dip below negative 100, and we've rallied back up above positive 100. So great. So far, so good. But we need to get above 60 to say we're going to get this kind of trend going, right? Where we're above 60 here for a while. And remember, on the DMI, the threshold is getting above 30, and getting the purple line below 20. So you see we're not there. We got the inklings. It's a very, very good start to this expiration cycle, to the week. Very, very good potential runaway gap type breakout pattern. I don't think it is, but it's got the potential of being one if we can hold it tomorrow and Wednesday. But some of these indicators still aren't quite confirming what we really need to see. I mean, we're above the cloud and we bounce back up above the green line. That's fine. We are close to getting above 80 again here, but we're not above 5 yet on this. So we're still not there. And you see the gap here between the red line and because this is how far above the 26-day. This is the 26-day return forward, right? The red line is. So this is basically the close today plotted 26 days ago. And you notice the gap here, which was really, really bullish, has shrunk, right? There's not very much of a gap anymore because we haven't moved. So we kind of really need to break out that gap, because if we stay sideways here, we're not like this high point. We're not above it. So it's kind of like, back over here when we were really, really bullish, we had a little bit of a gap, and then as soon as we rolled over, we went right through. And so we've got to keep that gap. Same thing over here. That gap got really, really small by the time it broke through. So it's getting really small, and we'd like to see that gap really break away again, back to the upside. Kind of give you an idea of what the Russell looks like, because Russell's been weaker up until today's move, which is this high point. This is Friday's move. That's how close we were to flirting with where we were here. So we need to see a gap like this reoccur and get back up. And in the case of the Russell, get out of this Ichimoku cloud, which it hasn't been able to do 2 times now. So you see kind of why we need a follow through from today. Follow through, great. No follow through, and then you can see wouldn't be so good, especially with a lot of open gap below us to fill in. Let's take a look at the intraday chart for the S&P, and you can see, we very, very good day, but so much of it occurred overnight on relatively light volume. The volume by the end of the day today actually wasn't bad. We ended up with 119 million shares. The trading range ended up, you can see again, 286.28 was Friday's close. Today's low was 292.70. So you had about a 6-point plus, almost 6.5 point opening gap. So you add, you're about 10.5 points here. That's well above the average. In fact, that's, we don't want to see too many more days like that. In fact, if we get another 10.5 point day, it's probably not going to be to the upside. It's probably going to be to the downside. So if we're going to hold this, we need to start getting back down to 7 point days or less, right? We need to get below 2%, below 1%, because that's where the trend begins, is when you're below that 1%, and we're still well above 1%. So we're still in a pretty volatile territory. In fact, as much as the VIX fell today, 8%, it didn't fall below this 90% mark. So it's still holding that support. It's still in a position where it's really easy for it to bounce up again, back towards 100%, if not higher. So, we're not starting the trend. According to a lot of these indicators, today wasn't a breakout to start the trend yet. It's a good sign, and there's a lot of good things about it, but we're not seeing everything we need to see to say, okay, here we are. We're on a bullish trend, and here we go. So to summarize our technical assessment, it was a good breakout pattern today. It wasn't a good enough of a breakout pattern where we saw all these indicators giving us the things that we need to see to establish, to show that we are on an established trend. We are still trying to establish a trend, and today was a good day we went a long way towards doing that today. A good breakout, but we need to hold it, right? It's one, if it's a fake out, remember fake outs, resistance fake outs are a lot more bearish than if resistance is held in the first place. So, we need to hold this and stay up above this resistance on the S&P, get the Russell back through its own resistance and get going here, and get the leadership back to the Qs. I know it's not great, but that's our current leadership. And if we're going to be bullish here now in the short term going forward into a more intermediate term, we've seen what the leadership has been. We need the leadership to continue to be that. That's what the leadership was before this whole coronavirus thing blew up. It's been the leadership throughout the whole coronavirus decline, and it's been the leadership through the bounce recovery. So the gap in performance, it didn't start off of this low point. It's been there for a long time. It's gone parabolic since the beginning of the year, well before the coronavirus issues cropped up, even over in China. So that's our leadership, and we need that to continue to be the leadership. So I know that normally we want to see small caps and value and international lead, and it did today, and that's fine. But we need to see the pullback in performance first, this parabolic move in tech to pull back first for that to happen. And so again, today was great, but if we're going to hold this, the Qs have to regain. They have to take over leadership again, because that's the train we're riding. We need to get back on that train and ride it some more. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll, and let us know. Do you agree or disagree? If you click disagree, comment down below as to why. What are you seeing? Indicators, charts, macro indicator, whatever. What are you seeing that suggests either you're a lot more bullish than I am, or you're a lot more bearish than I am right now? All right, so let's go ahead now and take a look at what's driving this price action, and then we'll get to our trade idea of the day. And so what I've done here is I've actually shown how the market has performed during that sideways action when the market didn't go anywhere, right? So if you were to actually, let's take a look at March 24th off. So the move off of the low, including the gap, up to that April 17th time frame, right, all the way up into the April expiration, right, where we got that last momentum peak up into the upper reversal zone on the market forecast, the red line getting up there. So you can see the S&P 500 did well, real estate, preferred stocks, not so, it's pretty typical. Gold, bonds, the dollar was down during that rally, and that's what you want. You want the dollar to be down. Stocks do best when the dollar's down. Crude oil was actually pretty bullish for a while, and then it pulled back here, and obviously we all know what happened with that. Had its own, USO at least had its own issues. Small cap underperformed, value underperformed. Growth stocks are doing really well. In fact, if I were to take a look at the sector really quickly and do the same comparison here for the sectors, I know we'll get into that segment here in just a second. But go to April the 17th. Then you can see from a sector rotation standpoint, energy stocks did really well. Real estate and utilities and we're actually outperforming up to April 17th. So it's like, that's not really the most growth-oriented areas of the market. Healthcare also did really well heading into that level. Okay, but since then, right, since the that April expiration, so you remember stocks themselves have gone pretty sideways since then. So let's go back here now and take a look at the April, and we'll go to the 18th. So after the Friday expiration up until now, up until this breakout pattern that we've had, you can see that the gold was up, international stocks were keeping track. Small cap stocks had been outperforming. They were underperforming going into that, but then they started to outperform here, but never really were able to. Remember, every time they had to run higher, every time they pulled away, it came down. Every time it pulled away, it came down. And so here's another instance of it pulling away, and we'll see if this takes or not. Everything else, as flat as a pancake, is kind of what you'd expect to see going into a slow breakout pattern. From a sector standpoint, doing the same comparison here, you go to April the 18th up till now, you'll see that this is a lot more like it, right? So you have technology, communication services, discretionary, energy, materials were up, even though the dollar wasn't down very much. But these are economic growth sensitive areas. The issues that we had in utilities and real estate were down. So remember, the market was flat here going into today for this month, and utilities and real estate, after leading up to that peak, were down. And then now you have, during a sideways market, you had these three cyclical areas leading the way higher. So it's interesting to see how we once we got that leadership, the market didn't go anywhere because they started to pull away. That again, the QQQ outperformance started to take off. I've shown you this chart before. This is the chart of XLK to XLI, and you can see how parabolic since the beginning of the year. So again, well before this coronavirus became a huge issue, since the beginning of the year, it was already on an uptrend as it was, and that's fine for it to be on an upward trend. But it has since gone extremely parabolic. and a little bit of a divergence now forming at these extreme highs. And you can see the MACD is super high, the PPO of the 50 and 200-day moving averages, which see this on a weekly chart. So yeah, these are the 10 and 40-week moving average. We're well up above. This gap is really taken off. That's a bubble. It's one thing for it to be positive and to move up to these in a range, but it's another thing for it to go from, a peak in this channel of 4, and this is, you have to go, I can go all the way back further to 20 years here to give you some perspective on this range. Here we are, the PPO. We had one little peak here, and you can see that was at the end of 2009, and XLI led the way higher off that low, as you would expect. XLI financials, they would lead off of that low point, and technology would underperform. A little bit of a bubble here. So we had a bubble over here, obviously. If we were to go back further, I don't know how far back this will let us go back. Let's see if it will let us go back over here. 1 second. There we go. So here's the XLI, XOK to XLI going into the late 90s, right? This is 99. You can see the parabolic move XOK took. Very, very similar. It did get up above, or right up to that 20% mark, and hence the 20% decline after that. So here we are again, working our way up to the 20% mark. We're at the 25% mark over there. Get rid of this zoom thumbnail over on the right so you can see a little bit better. There we go. So you can see again, it's a bubble. That's a bubble there. This is the normal range. To the upside 5%, to the downside -5%. That's the normal range. And you can see the bubbles when they've occurred, and when they've recovered, the bubbles recover and we get back into the range. Well, here's the bubble now, and at some point it will come down. And that's when you look at those two sector ETFs, when you look at QQQ relative to IWM. Oh, if I can type it right. How about I type it right? Well, that'd be good, wouldn't it? Yeah, let's go back and let's do IWM. There we go. So again, you can see, the performance, the pullback that we had, the sharp pullback that we had, and since then, here we are back. 15% move, but a gap between the 10 and 40-week moving averages. And just to show you what today did, this outperformance today so far basically has pulled us back to the 200-day moving average. Let me go out 5 years so we can zoom out a little bit. So it's pulled us back to the 200, but we haven't broken either one of these moving averages yet. We haven't broken down yet. And the question is going to be, when we fill in this gap, because we will, are we going to fill in that gap with IWM taking off and the Q's not, or is it going to fill in that gap with both coming down and the Q's is coming down more? That's the big question. But you can see the divergence that was formed, the extreme high that was formed there, and the gap that we have to fill in between that 50 and 200-day moving averages. I think ideally right now, for us to maintain this bullishness, we need this gap to persist, right? Just like it did in the 99. It got up to 20%. We're only at 15. It can go up higher. It's okay for this to bubble up a little bit, maybe slow down a little. And eventually we know it will roll over, but in the meantime, that's what's leading right now, and it's been leading this whole way. It's been leading through the beginning of the year. It's the performance, it's been leading to the decline, the coronavirus decline, and the subsequent recovery. We need it to continue to lead, to the upside while we maintain the current bullishness that we have. All right, so that leads us now to our trade idea of the day, and let's take a look. It's actually in, obviously, this leadership area that we're looking for. In this case, a discretionary area, and that's the Homebuilders. Homebuilders haven't been doing too hot lately, but they've been underperforming throughout most of this recovery until earnings season. And earnings season, they really took off, and you can see DHI, DR Horton broke out on this earnings. It's been sideways during this the rest of the expiration cycle, and then breaking out here today almost with an overbought cluster. In fact, at one point in time, I actually did have an overbought cluster. That's kind of why it stood out to me. But still, there's a lot of other factors. You can see its weekly candle on the Heikin-Ashi is closing well above its the last 3 weeks high point. So very, very bullish Heikin-Ashi candle to begin with, and you can see very strong close above the 200-day moving average. This is kind of what we want to see on the S&P, right? Not just do this, but break out even more and really solidify that. If you take a look at the three green arrows on DR Horton, you can see that its stochastics is rolling back up, a decent amount of volume. If I were to get to the 2-line versions of this, you can see we broke back above the 8-day moving average, broke above all these high points. The MACD is crossing above its moving average. You look at its RSI and CCI, a little bit of a pullback here late, but we broke above 60. We broke above 200 again. So good breakouts on that. You look at its oops, not the Bollinger Bands yet, but the DMI pattern, DMI indicator, and you can see we're breaking above 30 on the DMI, almost above 40, breaking below 20 again. So we're getting the breakout we want to see there. If you take a look at its Ichimoku cloud, you can see we're above 80 or above 5 on the daily chart. In fact, on the weekly chart, we're above 5 and above 80. So, and breaking up above the cloud here on the weekly chart, very, very good move. Now let's take a look at the Bollinger Bands, and you can see we are pushing up above. We're not breaking above the upper band. We are, however, breaking above the upper Keltner channel. So we've done that over here after the earnings. We had pulled back in, now breaking back out. Very, very good sign. Breakout pattern there. Now go back to the Bollinger Bands. You can see we're making our way towards that point of control, and again getting above it. There's a little bit of volume above, a little bit of a movement, but that's really our major resistance right there, getting above 54.5, and this thing can really take off, and the pattern suggests that we have the potential to do so. We got a lot of good breakout, really good bullish patterns developing, and from a relative strength standpoint, like I said, it's been underperforming and now it's rotating into some outperformance, and we want to take advantage of that with a long call option. So what we did today is we went and bought out of the money again, so we can position size around maximum loss. We don't have to use a stop order. We can get out at 50% of a stop, but we don't have to. We went with about a 3/4 of a normal position. If we normally position size around $1,000, here we're a little bit under $700. And that gives us the opportunity to, if it pulls back, we got plenty of room to work with, which we're fine, because you would expect after a decent move, a breakout move, you get at least some near-term weakness. But if it takes off, it continues to trend higher, great. We have plenty of opportunity. Breaking above the 54 and just getting the 54.5 will get us a return that's about half of what our max loss is. And then, of course, if it breaks through and trends higher, as you would expect it would, because of these patterns are suggesting we've got a good trend potential, and the golden, the long-term moving averages are showing a potential for a golden cross environment to emerge. Then, if we're going to be bullish here for the intermediate term, we'd expect the home building sector to kind of take off along with it. So it gives us a little bit of diversity. We've been really, in our bullish trades, we've been really focused on those QQQ names. Well, this gives us something in the cyclical leadership, but not necessarily, and something that has been lagging. So we have the opportunity here to take advantage of something that can rotate into favor, into some outperformance as it's doing so. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner. That takes us to our Market Outlook forums. Post any questions or comments you have there. Reply to anybody else's. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Follow me, at DavidSettle42 on Twitter for more content in between videos. And join our community at MarketScholars.com, as well as our Facebook group that we've created for Market Outlook viewers. As always, thanks again. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.